Today, we will be discussing my favorite topic, which I jokingly call Japan or Seppuku. Uh, you know, my favorite concept in macroeconomics was introduced to me about a decade ago by Mr. Mervyn King in his book, The End of Alchemy. The savings glut, the spending glut feed off one another and are rarely discussed in global finance. The savings glut is a nation which overwhelmingly saves money instead of spending. They saturate their domestic banking system, which forces the bank to look overseas for more competitive rates. With most people saving, there are few domestic borrowers. If banking institutions didn't go running overseas to find more competitive rates for savers, then there'd be a great deal of deflation in the domestic economy. Deflation is created when people do not spend money, right? And so, effectively, a nation that is a saver exports their deflation by lending overseas, and they import higher interest rate from foreign borrowers. Those foreign borrowers suppress deflation in the saving economy. Aggregate demand for goods tends to be low when you live in a nation of savers. So deflation is natural. The nation which best fits this shape is China. Because there are capital controls, people invest in real estate instead of equities, and they still save aggressively. A savings glut is a cultural phenomenon which is often coupled with a strong manufacturing base. This means that most of the nation's goods are produced in house. They don't have to import much. And secondly, they also have a pre existing culture of saving. A saving nation has the ability to export its savings to a spending nation. It can have higher rates for the domestic economy to further encourage saving and preventing the government from attempting to stipulate lending through interest rate suppression, printing money, or running deficits, printing money with extra steps. A spending glut is a nation which cannot stop spending, a nation of consumers, consuming to no end. The savings glut is a drug dealer, and the spending glut is a nation, a junkie, waiting for another hit. The spending nation maintains a high cost of living by consuming more than it produces and paying for this with its debt. If there was no nation offering its savings to the spending nation, then you'd get uncontrolled inflation led by a dramatically high aggregate demand until less people could consume. In other words, the prices would rise until too few people are able to purchase the goods. Interest rates skyrocket in the spending nation to incentivize saving and disincentivize consumption. What is key is that a spending nation does not exist except for demand for its debt. The nation which best fits this shape is the United States of America because GDP is 70% consumption. Japan and the US. This is a topic that I bring up with my co-producer here, and it's important. And I keep telling him that the most important phenomena in the global liquidity metrics in the entire global market is Japan. One of the nations chiefly responsible for excessive spending, for the excessive spending of the United States, both citizens and government, is Japan. The US Treasury alleged in June of 2024 that Japan held about $2.6 trillion in US assets, about a trillion in US equities, about $1.5 trillion in long-term debt, and about $75 billion in short-term debt. A significant portion of US debt owned in Japan is owned by the Bank of Japan, their central bank. How does Japan build up such a significant balance of US assets? Japan ran a trade surplus with the United States, which means they effectively exported their deflation. Their savers exported their money to the US to fund the spending and consumption of the US. For a great deal of time, this was the case. And they received US dollars in exchange and purchased US debt and US assets during this time. Over time, a sizable trade surplus produced risk for the saving nation. As the productivity of the spending nation peaks and even declines, the expected return on assets decline as well. The saving nation may attempt to exert power over the spending nation to exact returns and prevent losses from their foreign investments. China saw similar risk in their investments in the US and reduced their treasury holdings from about 1.3 trillion in 2013 to 700 billion in 2025 September. China at the helm of a booming economy and about 1.4 billion people and a powerful manufacturing economy. While it may be rocky, they can't adjust where their citizens save. Japan is far from its former self. At this point, their economy is dealing with democratic deflation, a scenario where there are not enough young people, high spenders, and too many older people, low spenders. Economies require young people because the establishment of the self and the establishment of a family increases economic activity. Young people are borrowers, investors, and spenders, while older people are savers and sellers and reduce their consumption. When there are a lot of elderly people in a population, it produces asset deflation. To deal with the shortage of young people, Japan automated much of their processes and moved production overseas to prevent raising prices. Japan's GDP per capita peaked at about 50,000 United States dollars and has since declined to 30,000 dollars. China is entering the same age trap with more people and a GDP per capita below 13,000 US dollars. Returning to Japan, to assuage demographic deflation, Japan is engaged in yield curve control. This is a last ditch attempt and a survival mechanism to prevent fiscal collapse. Financial repression, another name for yield curve control, is the single best tool to stave off the effects of an aging economy. If the government had to issue debt to cover fiscal costs at market rates, the higher rates would crush the budget. So the central bank acts and buys the government's debt to reduce the cost of the fiscal budget. Effectively, the central bank prints money and then purchases the government's debt. By suppressing market rates, the central bank forces people out of savings accounts and bonds earning well below 0.5% into equities and investments further out on the risk curve to beat out inflation. This produces a sort of zombie economy. Practices, companies, and entities that would not survive at 4% interest manage to survive at 0.4% interest. Currently, Japan is in a conundrum, right? This is what I've been talking about for quite some time. They've been purchasing US debt for decades. Now those bonds are underwater because US interest rates have dramatically risen fast. The Bank of Japan is sitting on unrealized losses, just like every other financial institution that holds US debt over the last 20 years. Japan likes to maintain a peg or a set price against the US dollar, and that peg is defended by selling US Treasuries to buy their Japanese yen. Japan sat underwater for a long time on US Treasuries and needs to defend their peg to enact stimulating programs to help their economy. However, as a top buyer of US Treasuries, they have an outsized effect as a seller and send US bond yields higher. Additionally, selling those treasuries underwater might convince people that the Bank of Japan is in a panic and may produce a run on the bank, a loss of confidence in the Japanese financial system. The other tool Japan might have to raise the value of their currency is to raise interest rates, which directly combats their yield curve control. This creates a significant panic in the Japanese financial system because the yield curve control has been the norm for quite some time, and it would bankrupt the fiscal budget as long as many banks along with it. If the rates go up, the pensioners who depend on bond prices would be in trouble as bond prices fall significantly. Japan cannot simultaneously act to save the currency and the bond market. Saving one means killing the other. Hence, the statement Japan or seppuku. The logic here is that Japan will always bow to the bound. The logic here is that Japan will always bow to the bond market and will continue their yield curve control. They have only one hope at the moment. The value of the US Treasuries break even when marked to market. This only happens if the Federal Reserve reduces rates significantly and possibly begins quantitative easing, adding a terrible amount of liquidity to the bond market. The Federal Reserve has been cutting rates off and on since, I believe, September of 2024. However, bond yields have not declined, not on the long end, and not terribly much so on the short end. And this is a problem for Japan, and it's a problem for the Federal Reserve as well. It signifies that the only way for the Federal Reserve to get bond yields down far enough for Japan to become solvent is to cut interest rates and buy US Treasuries, quantitative easing. The Federal Reserve Chairman Jerome Powell will walk out on the 10th of December and announce yet another rate cut, and this has always been inevitable. Chair Powell stated at the last meeting that a cut was far from certain, and markets were sent into a frenzy for reasons I can't explain. Anyone who knew anything about monetary policy and fiscal dominance had to know they have had one option all along. This will only temporarily help Japan's bond issue, but it won't be meaningful. The Federal Reserve will likely be forced to do a bond purchasing program, quantitative easing, money printing, counterfeiting, whatever you want to call it, not all too different from Japan's scenario for different reasons. A story for another podcast. The bottom line here is that Japan's story will be a centerpiece of financial markets for the foreseeable future, and I expect the Federal Reserve to act in their interest, not for the sake of Japan, our greatest ally, but rather to prevent a massive sell-off of assets which would produce a reverse wealth effect that would doom the United States to a recession. That's all, folks.